This is Darren Carlett with Dual Edge Research. This is a performance review for the Bull Strangle newsletter, which is a stock and option newsletter. And I also have a commodity futures spread trading newsletter that is called Smart Spreads. And I'll show you how to subscribe to these newsletters at the end of this video. This is a brief overview of the strategy. As an introduction, this strategy entails buying a stock and selling both a covered call and a cash secured put, or what some call a naked put, both of which are out of the money. The goal is to earn option premium while maintaining controlled stock risk. Here you see kind of how the trade is constructed. You can see that we're buying stock in 100 share increments, and then we are selling a call above and a put below. The range in between is kind of a style thing. People may want to keep this tight, which gets you more option premium, or you get a little looser and have the opportunity for more stock upside. The strategy combines three strategies into one single position. Obviously, the long stock, which allows you to participate in price increases. You have the covered call, which limits upside potential in exchange for receiving premium. And then you have the naked put, which generates income while creating an obligation to purchase additional shares. I have 5 videos on YouTube that describe the Bull Strangle strategy in detail. The first one is a high-level overview. It's a little less than 10 minutes. And then there is a 4-part video series that has about 3.5 hours worth of content that goes through the strategy in detail. Video 1 talks about stock options. Video 2 gets into the details of the strategy. Video 3 is on risk optimization. And then video 4 details the newsletter. You can search on YouTube for Dual Edge Research to find these videos. This provides a high-level overview of the core elements. Obviously, the most important part of the strategy is to pick quality stocks. And we're looking for stocks that are technically strong, using time-tested stock engine and a variety of different parameters that help us to get to stocks that are great candidates for covered call and naked put writing. We are sellers of option premium, which does give you the obligation to sell your stock at a set price and the obligation to buy additional shares at a set price. We talked a little bit about how the trades are constructed on the previous slide, but bottom line is we're buying shares in 100 or stock in 100 share increments and selling a call above and a put below. We're leveraging a weekly option cycle where we are on Monday placing trades that will expire 4 Fridays later. We are looking at the market environment and trying to be heavily invested during what we call green episodes, or times when the market is strong, and we are going to back off when the market isn't as strong. And we are very focused on diversification across sectors, across stock price, and across implied volatility. So that's a real quick overview of the strategy. As mentioned, you can go to my YouTube channel, SpreadEdge Capital, to get a lot more detail on the elements of the strategy. I always like to start off these performance reviews by reviewing the S&P 500, which is our benchmark for the Bull Strangle strategy. Since pretty much the entire year, we've been in a pretty strong uptrend, with the exception of the correction that happened in kind of the March-April timeframe. But last week, we were down 0.3%, which was the first decline in the past 7 weeks. This slide illustrates how the option premium impacts the total profit. This analysis includes 367 trades from February 2024 through August 29th. The data set is sorted high to low by stock gain percentage and then is divided into 20 equal buckets. On the left compares the stock gain to the trade gain, and recall that the trade gain includes the stock plus the options. And on the right is the same data, except it's in table form. Note that when you break this down into the different buckets, the first 5 blocks represents where the stock gains are capped by the covered calls. This is 25% of the time. And you can see that, once again, you can't go above once you reach that call strike price, your gains are then capped. So in this case, the stock gains were quite a bit higher than the options. The next block, which includes 6 through 11, is where the stock gains are amplified by the call and put premiums. And in each of these blocks, we see that the stock and options is higher. And of course, the same is true for blocks 12 through 15. But in this case, we actually took and turned a stock loss into a trade gain. And then the next block is where the stock lost and the trade lost, but the loss is reduced by the option premium. And then the very last block, which is 19 and 20, this is where the naked puts actually worsen the trade losses. Now, this last area is, of course, the worst case scenario, but note that that occurs about 10% of the time. Now, looking at this at a little bit higher level, we see that 25% of the time the stock gains are capped by the covered call. We see that 65% of the time the option premiums improve the overall performance, and then just 10% of the time the naked puts actually worsen the trade losses. All right, when we start talking about the different variations, I think that I tried to design this in a way that really simplifies thinking about all the different components of these different variations. Bottom line is you can trade up to 8 different strategies, which accommodates a very wide range of risk profiles. So there's really 4 strategies, but you can also add protective puts to any one of them, which then doubles it to 8. Now, the way I like to think about this is that there's really just 5 different components that are used throughout any of the strategies, right? The first is buying stock in 100-share increments, and then there is selling a call above the strike, there's selling a put below the strike, there's buying a put below the sold put, which turns that naked put into a put credit spread. And then there is buying a SPY, which is a S&P 500 or a QQQ protective put, which kind of protects the broader portfolio, not an individual stock. Now, as you go through this, these components are the same no matter what your strategy is. So for example, every strategy includes the green block, which is the stock, okay? And then the others become a little bit interchangeable, right? So a covered call naked put would include the green, blue, and yellow blocks, and so on. And you can see how you just add these different components to change the strategy up. This building block concept is covered in detail in the videos, but for the purposes of this review, I want to kind of give you a very high-level overview. Bottom line is I'm tracking a number of different variations so that people can, alter the strategy to fit their risk tolerance profile. But when I'm reviewing the performance, I'm only going to focus on the core strategy, which is listed here as the number 1. It's the covered call naked put. And as I've already mentioned, it involves what I'm calling the green building block, which is the stock, the blue building block, which is the call sold above, and the yellow building block, which is the put that is sold below. Okay, we'll start the open trade summary by going through the watch list for the cycle that ends next Friday on October the 3rd. For this cycle, we have 20 trades open. 14 of them are currently gaining, and that's the same as the stock gain. So the difference between the trade gain and the stock gain is the sold calls and puts. For this cycle, the average stock gain is up 8.9%, which is more than 3x the S&P, which is up 2.5% for the same period of time. For the next option expiration cycle, which would be 2 Fridays from now on October the 10th, for this watch list we had 22 trades. Currently, 19 of those 22 have a trade gain compared to just 59% on the stock win gain. So we see the power of the option selling that we've done. The average stock gain is 3.7%, which is a little over 4x the S&P 500 at 0.9%. Then finally is the 10/17 expiration cycle. These trades were opened last Monday, and of course the S&P was down 0.3% for this period, and the average stock gain was down 0.2%. So this cycle is not off to a great start. The average trade gain is 3.4%, which is clearly driven entirely by the option premiums that we've sold. Okay, that completes kind of the open trade summary. The rest of this presentation is going to be on closed trades. Okay, for the closed trades that expired on September the 26th, for this cycle we had 22 total trades, and the total win rate on the trades was 82% versus the stock win rate of 68%. But the comparison to the S&P 500 was very strong. The average stock gain was 9.1% compared to 2.8% for the S&P. So we beat the S&P by over 3x. And then the average trade gain was just 5.6%. So clearly we capped our gains a bit for this option cycle. And that's not unusual when we have a stock gain as high as this, 9.1%. Now, I will point out that for this option cycle, we did have 3 stocks that dropped more than 15%. You can see American Airlines, Toast Inc., and Upstart Holdings all did very poorly for this cycle. However, despite that, we had enough really strong performances that the total was still at a very strong 9.1%. This really demonstrates how looking at this over a portfolio, if you were to just trade one of these and it happened to be one of the ones that was down 15%, obviously that's not a good result. But if you spread out across as many different sectors as possible, you're going to see performance that, on some stocks that offsets the performance on others. Looking back at performance versus the S&P going back to the expiration on May the 23rd, I believe we've got 18 closed weeks and then the 3 open weeks, but there's just 1 week when the S&P outperformed the totality of the watch list. Now, when you look at the open trades, we do have the cycle that would expire this Friday and the next Friday, both pretty strong, well above the S&P, but the one that we just opened last week is slightly below. So we'll have to wait and see if the streak continues and this turns around. All right, so this is the performance of my personal account since inception back in February of 2024. I only trade the covered call naked put strategy, but I do track performance on all these other indicators. Right now, since inception, my personal account is up nearly 87% since inception. Now, remember that I trade 5 each week. I've always got 20 open, except, immediately after expiration. So I spread myself out across as many different sectors as I can and as many different weeks as I can. I'm very, very pleased with the performance. Now, one thing I would like to point out is that the stock only performance is at 95.52% and better than the performance when you add in the covered calls or the calls and the puts that we're selling at a premium. And this has been the case for the past several weeks. Now, I attribute this to a very strong stock market overall and very strong picks that we're making in the stock of the stocks on the watch list. So over time, and I think I illustrated this earlier in this video, we're not going to see this continue forever. But for right now, the stocks by themselves without selling option premium are doing exceedingly well. Dual Edge Research offers 2 powerful newsletters with one simple deal. This video has been about the Bull Strangle stock and option newsletter, but we also offer the Smart Spreads commodity futures newsletters. You can get both newsletters for the low price of $49 per month, with deep discounts available for 3-month, 6-month, and annual subscriptions. The annual subscription is a 35% discount, and for a limited time, you can get your first month for just $1 by using the coupon code on the website. Go to bullstrangle.com/products to purchase.